This week we will learn about pensions. Pensions are interesting and important topic because it gives both the employers and employees some tax incentives. And it is also important for a firm to disclose whether a pension plan is overfunded or underfunded. Although the textbook chapter mostly described defined benefit plans, but in real world we'll see companies are now more using defined contribution plans. So we will first learn what is a pension plan and then a concept of both plans, and mostly we'll see different accounting reporting for defined benefit plans. A pension plan is an arrangement or agreement between the employer and employees where there is a fund and the employer makes some payments or contribution to the fund, and when employees retires they get benefit from the fund. So this is the arrangement or promise the employer makes to their employees by providing some contributions, and these contributions or money are invested in the stock market, bond or other securities, and when the employees retire they also get the benefits. There are different types of pension plans. You will see one is contributory, another is non-contributory. So for contributory pension plans, employees bear a part of the cost or they voluntarily contribute some money for their future benefits. On the other hand, non-contributory plans, employees do not make any contribution, rather employer bears the entire cost. So remember, pension fund is a separate legal and accounting entity. So we will not focus on the accounting part of the fund, rather we will focus on the accounting of the employer. There are two types of plans that are commonly used. One is defined contribution plan, another is defined benefit plan. For defined contribution plan, employer contributes to a pension trust a specific amount each year based on a formula, and the accounting part is really simple. And here for defined contribution plan, the employer does not make any guarantee or promise that what's the ultimate benefit the employees will receive at their retirement. A common form of this plan is a 401k plan, and here when the employer contributes to the plan, the pension trust actually invests those money in the stock market or bond, and the employees gets the benefit if there is a gain, and also if there is a loss the employees need to face that. So here the employer simply just contribute a fixed amount based on the formula, and at the end of the year the employer record that obligated amount as their pension expense. So we'll see one quick example. Murphy Corporation sponsor a defined contribution plan for all full-time employees, and that is administered by Fidelity. And the condition of this plan is that Murphy will contribute 1.25% of its pre-tax operating income to the plan each year. And December 31st, 2025, Murphy reports their pre-tax operating income is 2.48 million. So how they will record their pension expense? So this is very simple. It's just based on their operating income, and that percentage 1.25 Murphy will calculate the pension expense and they will record it. So the pension expense for 2025 will be 1.25% of their pre-tax income, which is $31,000, and they are contributing that money to the pension trust or the plan, and they will credit cash. That's it. Remember, here they will not record any liabilities, because in this type of plan the employer does not guarantee or make any promise the specific amount that the employees will receive at their retirement. They just fulfill by paying that their specific amount each year to the pension plan, but now the rest is based on where the pension money is invested, and based on the gain or loss made through that pension trust, the employees will receive the benefit at the end. We will learn about the other type of plan, defined benefit plans. So for this type of plan, the employer actually outlines, or the plan defines what's the benefit the employees will receive when they will retire, and these benefits are typically a function of an employee's number of years service and the compensation level that they receive throughout their working period. And remember, employees are the beneficiaries of a defined contribution trust. Beneficiaries means who ultimately receive the benefit. But for a defined benefit trust, the employer is the beneficiaries. So we need to remember a few other items under the defined benefit plans. Employers take the risk because employers make a promise, and employers already guarantees that what the employees will receive at their retirement. So they need to make sure that they contribute enough so that the cost of those benefits are covered, and then at the end of the year they record pension expense, but that pension expense is not necessarily equal to the cash contribution they make. So they also need to record pension liabilities, and the measurement of the liability is also controversial because it's a future payment the employees will receive. So there are several unknown variables that are involved when we need to calculate the pension liabilities, and that's why employers heavily rely on actuaries. So actuaries are those expertise. They actually use different variables such as the employee's mortality rate and turnover, interest rate, early retirement chance, current salary, future salary, and several other factors to estimate the amount. And in many cases those are depending on several factors, so the measurement of the liabilities can be controversial. Oh, we have seen that for defined contribution plan, employers only record pension expense, but for defined benefits plan, employers need to record both pension obligation, that means pension liability, and pension expense. So it is a crucial question for the employers how to measure the pension liability. So here there are several ways how they will measure the pension obligations and liabilities. Number one is called the vested benefit obligation. This measure is based only on the benefits vested to the employees at current salary levels. Vested benefits are those that the employee is entitled to receive even if he or she is no longer employed by the company. And on the other hand, you will see accumulated benefit obligations. This measure uses both the vested and non-vested years of service. The company computes the deferred compensation amount on all years of employee service, both vested and non-vested, but they use current salary. On the other hand, there is another way to measure the pension obligation, which is projected benefit obligation, which is commonly used. We will also use it for the chapter, throughout the chapter, which means that here this measure bases the deferred compensation amount on both vested and non-vested service, but they use the future salaries. So we also call it PBO, or projected benefit obligation, and we'll see most of those problems and the rest of the chapters are assuming that the liability is measured or based on this third approach, or PBO. So if we want to compare it, remember those are vested years, those are at current salary level, those are both vested and non-vested years. Current salary level and projected benefit obligations, it is both vested and non-vested, and future salary level. So of course this liability will show the larger amount of obligations or liability, and FASB also prefers that. So for this chapter we will learn about this projected benefit obligation, liability, and several other accounting parts related to it. So the FASB prefers to use the projected benefit obligations or PBO. Remember, this is a liabilities. So we have to compare this PBO or projected benefit obligation liability with the plan asset, because when the employers contributes to the plan, those money is invested in the stock market or bond or in other securities, and we have to check the fair value of those plan assets. And if the PBO or projected benefit obligation, which is a liability, is greater than the value of the plan assets, we will call it the plan is underfunded, because this is a liability and this is the value of the asset to meet up those liabilities. So if liability or PBO is higher, we call it underfunded, and pension liability will be reported on the balance sheet, of course the liability side. On the other hand, if we see PBO amount is lower than the value of the plan asset, then we will call it that this plan is overfunded, and the difference which will show as pension asset on the asset side of the balance sheet. Let's see a quick example. Coker Company has a projected benefit obligation of $300,000. Fair value of the plan asset is $210,000. So of course it is underfunded because the PBO or obligation or liability is 300,000, but the fair value of the asset, plan asset, is $210,000. So it is underfunded by $90,000.